All right, so can we continue? Remember, we're still continuing with study unit 1, and we are now looking at from study unit 1. We remember we are expected to cover chapter 1 of Mandayapadi, chapter 2 of Whitney, which we have covered already. Now we're going to be looking at chapter 2 of C.B. Joseph as well. And remember, under this, under C.B. Joseph, they said that we should be able to answer the following questions. What do you mean by credit risk analysis? Explain how the traditional 5Cs model is augmented in modern credit risk analysis. And one of your friends argues that borrowers need to study credit risk analysis because of it is the territory of the does not need to cover credit risk analysis because it is the territory of the lending business. Do you agree? And please elaborate as well. So when you look at chapter 2 of C.B. Joseph, we look at essentials of credit risk analysis. So we look at essentials of credit risk analysis. And here they say, when you look at the meaning of credit risk, they say, credit risk refers to the probability of the loss emanating from the credit extended to it as a result of the non-fulfillment of contractual obligations arising from unwillingness or inability of the counterparty or for any other reason. If the probability of the loss is high, the credit risk involved is also high, and vice versa as well. So which means looking at credit risk here, we look at where they say the overall credit risk is looked at in two different ways, where you look at the single borrower credit risk, and then you also look at the portfolio credit risk as well. So you can look at it from a single borrower's perspective, or you can look at it from the portfolio's perspective as well. So from a single borrower's perspective, this is where you look at credit risk of an individual customer. And remember, if they say obliga, if they use the word obliga, please take note that it's still referring to a borrower as well. So the borrower is also referred to, in this case, as the obliga. So which means, in this case, when we look at the causes of credit risk, they say credit risk is subtle and hidden and has to be unearthed carefully, especially in view of the fact the returns for credit risk are much lower than those kinds of investments such as equity or real estate. So in fact, credit risk is the product of a variety of events, some controllable and others uncontrollable. So when you look at credit risk, they are saying the credit risk in this case is where you say it can be coming from systematic risk or unsystematic risk. So which means the credit risk coming from systematic risk is the one that we deem to be uncontrollable. And then the credit risk coming from unsystematic risk is the one that we deem to be controllable or within the control of the organization. So systematic risk is basically that risk that affects everyone within an economic system. So the risk that affects everyone within an economic system is what we deem to be systematic risk, such as the social-political risks, the economic risks, and other exogenous risks, like, for example, other risks coming from the external within the business environment as well. Like, for example, where we see the effects of the COVID-19 as well. Then there's also unsystematic risk, where this is the risk that is coming from business risk and financial risk as well. And remember, when you look at business risk, this is the risk coming from the day-to-day operations of the business. And then financial risk is the risk emanating from the financing of the business as well. So when you look at this risk as well, when you look at this risk, remember we say, when you look at the bank, the accounting equation says your assets is equal to equity plus liabilities. So which means in this case, the liabilities is typically the debt financing of the bank, like, for example, typically through money contributed by the depositors, right? And then the assets typically would be the loans that the banks are giving out. So it means that the loans that the banks are giving out is basically what we deem to be the assets of the business, which means in this case, when you look at the overall risk, we say the total risk faced by an organization is given as systematic risk, and unsystematic risk. The systematic risk faced by the bank is the one that we deem to be uncontrollable. So it's the one that we deem to be uncontrollable. And then the unsystematic risk faced by the bank is the one that we deem to be controllable, because we're saying this risk is the risk that is going to be within the control of the business organization. So another way of describing systematic risk is where we refer to it as non-diversifiable risk. And unsystematic risk is the one that we refer to as diversifiable risk. Now, when we talk about non-diversifiable risk and diversifiable risk, we're basically saying this is the risk that no matter when it comes to the diversifiable risk, we're basically saying that this is the risk that's going to be reducing with the more the number of assets you have within a particular bank as well. And the non-diversifiable risk is that risk that we're expecting to remain constant, regardless of how many different assets you have within the banking system. Now, when you look at this as well, your total risk is measured by standard deviation. So standard deviation measures total risk. So your standard deviation measures your total risk. And your systematic risk is measured by the beta. Sometimes we use this notation, representing beta. So whenever you see them referring to your beta, you should know that they are referring to systematic risk. And whenever you see where they're talking about standard deviation, you should know they are also, in this case, referring to total risk faced by the organization. So which means as a graph, when you're trying to understand systematic risk and unsystematic risk, we are saying when you look at the total risk faced by the organization, this total risk, when you look at the total risk versus the number of securities, we are saying remember we said your systematic risk is that risk that affects everyone in the economy, right? So since it's the risk that affects everyone within in economic system, it also means that no matter how many different securities you have, that risk is expected to remain fixed or remain constant. But now, when it comes to the unsystematic risk, remember this is the risk that you said is diversifiable. It's diversifiable in the sense that the more the different number of securities you have within the economic system, the lower that risk comes as well. So the more the number of different securities you have in the economic system, the lower the risk becomes as well. So the aim is to have a situation where your unsystematic reduces to an extent where it becomes zero, and the only risk that you're going to be worrying about within an economic system becomes the systematic risk. Which means the more the different securities you have, the more the risk you are going to be able to diversify away, so that the only risk that you are going to be left with there is the systematic risk, which we said this is the risk that affects what? Everyone within an economic system. So that's the relationship between systematic and unsystematic. Are we on the same page? Any questions? Anyone lost?
Hi, Reno.
Yes.
Yes. According to this formula, right? So I can see total risk is equals to systematic and then unsystematic. So then I just needed to understand because just my logic is saying that if it's systematic, then it has to be controllable. If it's unsystematic, it has to be uncontrollable. So then why is the systematic uncontrollable and the unsystematic controllable? Maybe if you can just explain those two scenarios.
Remember, when we talk about systematic risk, we say it's uncontrollable because it's not within the control of the organization to reduce it.
Okay.
Like, for example, when it comes to the impacts of the pandemic, right?
Yes.
No matter what your business could do, the risk was always going to be there. So no matter whether you decide to invest, like, for example, when you talk about controllable, right? Remember we said the systematic risk remains constant, but the unsystematic risk reduced there, right? Like, for example, when we went through the pandemic, right? Whether you decide to invest in shares in BMW, or you buy shares in Tesla, or you buy shares in Mercedes-Benz, they were all affected by the effect of the pandemic. So the effect of the pandemic basically affected everyone throughout the economic system. That's why we're saying it's not within the control of the organization. Why? Because the only other way that you can try to reduce that risk is by trying to invest in different securities. But now, when it comes to systematic risk, even if you now move your money to this security, you're still going to be affected by the effect of the pandemic, which means that's why we deem it to be a systematic risk to be uncontrollable, because there's nothing that you can do to reduce its effect, because it's within the effect, or the source of the effect is outside the control of your organization.
Okay, and then controllable?
Then controllable risks now are those risks that you can try to do away with by investing in different securities. Like, for example, if you are going to be given an option to say, invest in ShopRite and invest in BMW shares as one option, then the second option, they say invest in BMW and then invest in, let's say, Mercedes-Benz. You will see that you are better off investing in BMW and ShopRite, because they're not related to each other, because they're in different sectors, instead of putting your money in BMW and Mercedes, or alternatively putting all your money in BMW investment as well, which means the more the different securities you have from different sectors or economic activities as well, the more diversified your portfolio becomes, because the more you have that, it means when one performs well, that good performance is going to end up raising the performance of the overall portfolio when the others fail as well. Hence, you're able to get what? A good performance overall.
Okay, then. Okay, thank you.
So
Yes.
the key thing there is that we are saying when you diversify your portfolio, this unsystematic risk starts reducing, depending on how many different securities you're going to be having in your portfolio as well. So the more different securities you have in your portfolio, the more this risk becomes lower and lower, which means if you're now going to be having a portfolio where you are invested in so many different securities in a particular market as well, the expectation is that your unsystematic risk would have been lowered. But ideally, the reason why we are going to discuss this later on as well is that the reason why we are saying as an investment or as a bank, we want to reduce this unsystematic risk is mainly because when you are giving out loans to customers, if you are going to be charging them 10%, right? Whether they take on more risk or they don't take on more risk, you're still going to be getting 10% from that customer, right? So which means now, if you only give one customer, or let's say, for example, you have 100,000 that you are able to give out as loans. If you only give one customer the 400,000, if they default, what is going to happen? You're going to lose all your money. But let's say, for example, on that 100,000 amount that you are looking to give out to customers as well, if you now give it to different people from a lending perspective, if you give, say, 10,000 this one, 10,000 this one, you have 10 customers that you've given 10,000. If one customer defaults, it means you're expecting to recover from the other customers as well.
From the 9,
So the more diversified you are, the lower this risk becomes, instead of what? Concentrating on one customer, which means the key thing there is to invest in different securities.
Okay, thank you. Thank you so much.
All right. Are there any other questions? All right. On the next section, we look at credit risk and return. So on the next section, we look at credit risk and return. And here they say, economic agents involved with credit risk will attempt to maximize return for a given level of risk, or to minimize the credit risk for a given level of return. Now, looking at this relationship, it goes back to the analysis where we are saying, let's say, for example, we look at a graph, which is something like this. So we look at a graph which shows us the relationship between return.
Renas, sorry, can you check your sound? You sound very far. I'm not sure if I'm the only one who's struggling to hear.
All right. All right. Is it much better now? Is it much better now?
Yeah.
Please just make sure that when you are talking as well, I can hear a reverb in the background, or just so make sure that you check your network connection as well. Just make sure that there's no reverb and good network connection, because if your network connection is not as good, sometimes the sound becomes up and down as well. So when you you look at the relationship between return and risk, so when you look at the relationship between return and risk, when you look at this relationship, let's say, for example, you have customer A and customer B. So customer A and customer B, they are earning the same return, let's say 10% return. But customer A is on a risk level of 1, and customer B is on a risk level of 2. So which of these two customers, which of these two investments would you prefer to invest in? Would you prefer to invest in A, or would you prefer to invest in B, given that they're earning the same return, but customer B has a risk rating of a risk of 2, and customer A has the amount of risk which is equal to 1? So which of the two customers would you prefer to invest in? So which one of the two investments would you invest in? Investment A or investment B, and why? So which of the two investments would you prefer to invest in? Investment A, where it's earning 10% return, but the amount of risk that they're taking is 1, or investment B, where they're earning 10% return, but the amount of risk that they're taking is equal to 2.
A is lesser risk, same
Yes.
investment.
So which means,
return.
yes. So which means when it comes to investment, the aim when it comes to investment is to maximize, is to minimize risk for a given level of return. So the aim of investment is to minimize the risk for a given level of return. That's why you would choose to invest in investment A, because for the same return, you are going to be exposed to lower risk. And then the same applies. Let's say, for example, you are also given investment C, and with investment C, let's say with investment C, you are given that both investment B and C, they're exposed to the same amount of risk, but investment C is generating a return of 17%, and investment B is generating a return of 10%. So if you are going to be asked to choose between investment C and A, which of the two, investment C and B, which of the two investments would you choose and why?
C, because
And
of
why?
the return will be higher.
Yes. So for the same amount of risk, C is earning a higher return, isn't it? So which means when you look at the risk-return relationship, our aim is to maximize return for a given level of risk. So the aim would be to maximize the return for a given level of risk. So that would be the aim. So which means with the investment principle, where you look at the relationship between risk and return, the investment principle is that you as an investor, you want to be able to maximize a return for a given level of risk. And at the same time, you want to be able to minimize the risk for a given level of return as well. Are we on the same page? Any questions? Anyone lost? On section 2.4, we look at credit risk analysis. So in section 2.4, we look at credit risk analysis. And here they say, credit risk analysis is the study from the perspective of the supplier of credit of a present or prospective claim on another economic agent, both disaggregation or aggregation basis. in the form of debt, including trade payables, loans, public securities, amongst others. So when you look at credit risk analysis, the institutions that need to do credit risk analysis is typically the banks or financial institutions, mutual funds or insurance companies, the manufacturer or traders, as well as hedge funds as well. So these are the typical institutions that needs to do a credit risk analysis. And here they say, besides suppliers of credit, there are other parties who have a general interest in the creditworthiness of an economic agent. These parties are typically potential customer or buyer, because remember, the potential customers or buyer, they want to ensure that the company is able to continue as a going concern. And because of this, it means that because they want someone who can consistently supply them with the inputs that they need, they want to ensure that the organization is able to continue as what? As a going concern as well. And then there's also the auditor. And in this case, the auditor also is interested in credit risk analysis to assess the probability of an imminent financial distress of the organization as well. Then there's also borrowers. And remember, the borrowers are the parties who are being owed as well. And they're also interested in credit risk analysis to ensure that whoever their supplier of credit is also going to be able to continue as a going concern. Because remember, if they're going to be borrowing this money for a period of 10 years or a period of 20 years as well, it means that if the borrower faces financial difficulties, they might be forced to repay this money sooner than what is anticipated as well. So are we on the same page so far on what we've covered? Any questions? There is a section where we look at the historical progress of credit risk analysis, and I don't think anything would come out of this particular section. I don't see anything coming out of this particular section. Then there's also the need for credit risk analysis. And when you look at the need for credit risk analysis, they say we need to do credit risk analysis for, and the first reason why we need to do credit risk analysis is for prudence, where they say demand for credit is pervasive, given the insatiable desires constrained by limited resources. And credit is one technique adopted to overcome this problem. However, it is the responsibility of the supplier of credit to ensure that their actions are prudent, because excessive credit will prove disadvantageous to almost everyone in the economy. Because if excess credit is going to be given in the economy, people are going to be over-indebted. And if people are over-indebted, it means that people are going to be likely going to be defaulting on their obligation as well. Then they say the only alternative left is to conduct a proper risk analysis of the credit, where you ascertain, measure, and manage the credit risk in such a manner that it does not spin out of control. The second reason for credit risk analysis is the issue of the increase in bankruptcies, where they say during a recession, bankruptcies multiply. So during a recession, the risk is that bankruptcies multiply during the recession. So in this case, they're saying the economy goes through different phases. So they're saying the economy goes through different phases. So the economy goes through the different phases over time. So the economy goes through typically the expansionary phase, and then the recessionary phase. And at the top is where the economy reaches its peak. And at the bottom is where the economy reaches its trough. And from there, you are expecting an improvement there as well. So what do we find? Typically, during the expansionary phase, companies are doing well. So which means during the expansionary phase, the risk of bankruptcies is lower. But when the economy goes through the recessionary phase, because of difficult economic environment, you are also expecting the risk of bankruptcy to be high as well. So as the economy goes through these different phases as well, it basically means that the supply of credit also needs to be able to continuously do a credit risk analysis so that they're able to check to see exactly what is happening to their customers as the economy goes through these ups and downs as well. Because we know as the economy goes through the expansionary phase, the risk of bankruptcy is lower. And as the economy goes through the recessionary phase, the risk of bankruptcy is also expected to be increasing as well. So which means credit risk analysis basically allows the company to keep tab of potential bankruptcies as the economy goes through different phases as well. Are we on the same page? Another issue is to do with increase in competition. So it's another issue is to do with increase in competition, where they say with increase in competition, naturally pricing is under pressure. So when margins get thinner, even the previously acceptable level of bad debts would become unacceptable. So which means when competition increases, remember we said when it comes to the credit instruments, we say that your nominal interest is given as the real rate plus expected inflation plus risk premium. And we said this typically is your risk-free rate. So as a proxy for the risk-free rate, they can also use the return on short-term government instruments like treasury bills. So they can use the return on treasury bills as a proxy for the risk-free rate. But now, how they now ensure that they price their credit or the interest that they're going to be charging the customer, the interest is going to be dependent on the risk premium, which means the higher the probability of default of the particular customer. Remember, customers, before you give out credit to the customers, you need to check to see exactly what category are they falling under, depending on the probability of default. And based on the probability of default in category, you can see how much extra layer of interest am I going to be putting to cater for the expected losses in case the customer defaults as well. But now, this additional layer of interest that will be charged by the customer to the customer, depending on their risk premium, if competition increases, it means you, as a supplier of credit, you are going to be forced to lower the interest rate, right? But now, if you lower the interest to such an extent that you are not properly accounting for this risk premium, it means you are going to be running the risk that your business is going to be, you are going to be running out of business when the customer starts defaulting, and at the same time, you don't have enough, you have not charged enough interest to cater for these expected losses due to default as well, which means competition now forces the supplier of credit to lower the interest. And if they lower the interest, it means they're going to end up undercharging when it comes to properly compensating for the risk that they're going to be taking. So which means they're taking on too much risk for a lower return. But remember, we say normally or naturally, when the risk increases, a rational investor would expect what? A higher expected return as well. Are we on the same page? Any questions? So increase in competition lowers potential interest that is going to be charged, which means that the supply of credit might end up finding themselves in a situation where they are not properly pricing their credit products as well, which means that they are going to be faced with high levels of bad debts, and at the same time meaning that they're taking on too much risk for a lower return. Then they also look at volatility of collateral or asset values. And when you look at volatility of collateral asset values, they say, while it is no longer easy to insist on collateral in view of the increasing competition in the market, the value of collateral also fluctuates widely, as it has been witnessed in Japan, in the Far East, and also in the US as well. So when it comes to the issue of collateral, this is where we are now looking to say, in case of a loss, two things are going to happen in case of a loss. So two things are expected to happen in case of a loss. There is going to be recovery rate, and then there's going to be the loss given default as well. So which means in case of a loss, things are going to happen. There's going to be loss that's going to be suffered, or there's going to be recovery rate, which means for the supplier of credit to avoid losing out money in case of a default as well, in this case, in the case of a default. Remember, the loss in this case is resulting from the default by the customer, right? So which means to mitigate the effects of potential losses suffered because of default as well, the supplier of credit will try to mitigate that loss by what? Making sure that they have collateral, they have enough collateral to recover as much as they can from the customer in case of a default. So they want to make sure that they have enough collateral to recover from the customer in case of default. But now, let's say, for example, the customer provides shares as collateral on their loan. The problem that might be experienced there is that when the economy goes through the recession, the value of those shares sometimes are also expected to decline. And if the value of the shares decline, it means the value of the collateral is going to decline. And if the value of the collateral declines, it means the recovery rate is also going to decline, because there's now a risk that in case of default, even if we recover something from those shares, we might not end up recovering the amount that we're expecting to recover, so that we don't end up suffering large losses as well. Which means if the recovery rate is lower, it means that the loss given default is going to end up being higher as well. So this is the reason why we need to do a credit risk analysis to ensure that we are able to ensure that the value of the collateral is going to be sufficient to have a higher recovery rate, so that we minimize the loss given default as well. Are we on the same page? There is also the issue of poor asset quality, where they say non-performing assets is the term used to denote credit assets that are on the verge of becoming credit losses. So which means we need to do a credit risk analysis for us to identify the poor asset, those assets with poor asset quality. Because if we're able to identify those assets with poor asset quality, we are able to now make that decision to say, so should we retain them, or should we rather minimize our losses by selling them off as well? So which means the only way you're going to be able to identify the poor asset, for the non-performing assets, those which are of poor quality as well, and being able to make that decision to say, should we keep them on the book or should we rather get rid of them as well? For you to be able to do that, you need to do a credit risk analysis. Then there is also the issue of high impact of the credit losses. And here they say, I'll read from the beginning of the paragraph. They say, it is a common perception that a small percentage of bad debt is acceptable and won't do much damage. However, unfortunately, it is not the case. Even a small credit facility that will help the business, if it turns bad, especially for banks and other intermediaries operating in a highly competitive sector. Because remember, in a highly competitive sector, it means even if the margins are going to be small. And if the margins are small, it means if, for example, your margin is 2%, it means you're expecting to generate 2% as a return from your credit assets. But now what happens if your default rate becomes 2% as well? It means those margins are going to end up being absorbed by the default rate, which means that the company or the organization is going to overly be affected by the effect of what? The default by a small customer as well, because that default will be significant enough to actually absorb the potential gains that would have been absorbed, that would have been gotten from other customers as well. Then there is proliferation of limited liability entities. And here they say, while this accelerated risk-taking, the new arrangement shifted the onerous burden to the creditors to ensure the creditworthiness of the business enterprises separately from the shareholders. So remember, when you look at limited liability entities, we're basically saying these are entities where, in case something goes wrong with the business, the maximum that the creditors are able to recover from the business is what is invested in the business, which means that there's a separation between the business and the owners of the business, which means that in case something goes wrong with the business, the maximum that the suppliers of credit are able to get is what they can recover from within the business itself, not from what the owners of the business privately own or whatever investment that they may have elsewhere. The creditors are not going to be able to touch that amount of funding as well. So because of this, it means that with limited liability entities, it means in essence, it has effectively transferred the risk from the owners of the business to the creditors. So which means with a credit risk analysis as well, it means that the creditors or the suppliers of credit are going to be able to make sure that the company or the organization is not going to be ending up failing to meet their obligations, because continuously you are going to ensure that before you even give out credit, you do a credit risk analysis, and even after the credit has been given out as well, there's going to be continuous analysis and review and monitoring of the supply of the obligor in that case. Point number 8 looks at risk versus return matching. And then they say different levels of risk require varying returns. So as the credit risk increases, so should the returns in order to compensate for the higher risk taken. So which means when you look at the risk versus return matching, we're basically saying a rational investor expects that as the risk is increasing, the expected return should be higher, which means when you look at this picture, we are saying, when you look at this formula, when the risk premium increases, we are also expecting the interest charged to increase as well. So this is how you look at the matching between risk and return. When the expected risk increases, we're also expecting that the supplier of credit should charge higher interest rate, so that they're able to compensate for the increase in risk as well. The next one looks at disintermediation, and here they say, with the expansion of secondary capital and debt markets, many credit-worthy customers, especially the larger ones, access and raise funds directly from the public. So which means because of this, it basically means that there is need for a good credit risk analysis before one gives out this money. Because remember, at the end of the day, if there's going to be any default there, it means that the general public is going to end up what? Being affected by the effect of what? Failure to repay these particular loans as well. Because typically, we are saying with disintermediation, typically we are saying that under normal circumstances, we have the supplier of credit and we have the party who demands. So which means with disintermediation, we are saying normally we expect this relationship where we have the party with excess funds and you have the party with a deficit of funds. And then we have the intermediary. So we have the intermediary. And the intermediary is typically a financial institution like a bank. So which means the party with excess funds is going to be giving money to the intermediary, like depositing money to the bank, so that the bank supplies the party with a deficit of funds. And in exchange, the party with the deficit of funds pays the bank interest, and then the bank also pay the supplier of funds, typically interest as well. Although we know that how the bank makes money is that they'll charge a higher interest here and pay a lower interest there as well. So that's how the bank would make money. So with this intermediation, this is where the party with the party with the deficit of funds issues instruments directly to the public to get funding. Like for example, they issue bonds directly to the public. So this is where you look at this intermediation where the party with the deficit of funds, they are going to be issuing debt instruments directly to the party with the excess funds. And the party with excess funds, for example, typically they would want to invest in, for example, bonds as well. We also have off-sheet balance sheet transactions, and yet they say usage of other off-sheet balance sheet transactions such as operating leases, factoring with recourse, discontinuing of bills are not uncommon. And because of these, this is why there is a need for a good credit risk analysis. Because remember, with all these off-balance sheet transactions, they are not necessarily going to be reflecting on the balance sheet to show the overall risk being faced by the obligor. But at the same time, in case of if anything goes wrong, it basically means that there is going to be if you are a supplier of credit as well, you are going to be negatively affected when what if the off-sheet balance sheet transaction that the obligor is going to be doing ends up backfiring on them as well, which means that they're going to end up losing out money there, which means that it also increases the risk that what you as a supplier of credit as well, the bank or the obligor is going to end up what failing to service their credit assets as well. So I'm on the same page when it comes to the need for credit risk analysis. Any questions? On section 2.7, they look at the challenges in credit risk analysis. And the first challenge that they discuss there is the reliability of the data. So when you do a credit risk analysis, the first challenge is the reliability of data, where they say, in order to conduct a credit risk study, analysts require a substantial amount of data and information related to the general economy, industry, and the borrower. So financial statements are one of the major sources of data. So usually, audited accounts are relied on heavily by banks, financial and credit institutions. They take comfort from the fact that the books of accounts are audited by financial experts. However, the collapse of several high-profile institutions just months after a clean report issued by their auditors cast a long shadow over audited accounts as well. And we've seen this quite a lot when it comes to these audit firms, like what we saw is recently when it comes to KPMG as well. Then there's also profitability of business considerations. And here they say the management team is also usually incentivized to aim at higher profits that will result in bonuses for key executives and dividends for the shareholders. So sometimes the overriding focus on profitability blinds the decision on risk-taking with disastrous consequences. And we've seen this quite a lot when it comes to the 2007-2008 financial crisis as well. Then there's unpredictable future, where they say historical analysis of the borrower is done with an underlying assumption that the past track record provides a rough guide to the future, which means the past does not necessarily predict the future, which means going to the future. And as you can see, the market factors that are affecting the performance of the obligors are constantly changing. Like what we've seen so far, you see that we've seen what happened during the recession. We've seen what has happened when it comes to the Russia-Ukraine war as well. It has affected so many other businesses. And we've seen recently now what is happening when it comes to the issue of the tariffs as well, which means that if the company is going to be relying on imported exports as well, there is going to be an effect on risk when it comes to going concern of that organization. Then we also look at the reliability of risk models. And here they say, often the reliability of models decreases with complexity and the assumption based on which the models are developed, which means that in this case, we see that the model used to predict the dot-com crash in 2001 could not have been used to predict the crash in 2008 as variables were different. The dot-com crash was based on the IT industry, and then the 2008 financial crisis was more based on the real estate instruments as well. And because of this, it basically means that some of these risk models might not be reliable in dealing with potential or reliable in dealing with risk exposures emanating from going into the future as well, because it's not necessarily that they're going to be, because some of them, they are going to be, that's why you see that the Basel Accords is constantly being improved as well, because some of these risks are going to be emanating from risk factors which not necessarily would have been accounted for by some of these existing risk models as well. Are we on the same page? On section 2.8, we look at the elements of credit risk analysis. And when you look at the elements of credit risk analysis, we look at the 5 C's of credit. And when it comes to the 5 C's of credit, the last time it was asked is when you look at the 2021 question paper, this is where they discuss the 5 C's of credit. And yet they say, as a senior credit manager at Famous Bank Limited, a junior credit analyst approaches you regarding the literature on credit risk models. He had spent 4 weeks reviewing the literature on credit risk models, but is struggling to comprehend the 5 C's. So prepare a comprehensive response to the complete satisfaction of the junior analyst as well when it comes to the 5 C's of credit. So going back to the 5 C's of credit, please note that the 5 C's of credit are discussed in the order of importance. So the character is the most important one, followed by capital, capacity, conditions, as well as collateral as well. So when they talk about the character of the borrower, in this case, they say, the character, this shows the integrity and honesty of the borrower to settle their dues on time. So it is pertinent to say that the history of credit has recorded several instances where the borrower had the capacity to repay, but not the willingness. So credit extended to a crook can be considered a credit loss from its very inception. So an analyst will take an informed view about the character of the borrower through the study of the ownership and management, as well as the past track record. Appropriate market inquiries are also needed. Then capital, a prudent lender would ensure that the borrower has a sufficient stake in the business. Hence, the higher the capital contribution by the owners of the business, the better. So lenders need to ensure that a substantial interest of the entrepreneur is at stake should the business fail. Then there's also capacity, where they say the borrower's capacity to meet their debt service obligation must be studied. In the case of business lending, this is done through the study of financial statements. That is financial analysis, including the interpretation of financial ratios that indicate the borrower's ability to pay. Since the business is influenced by the wider economy, the study of the economic conditions is also necessary to assess the capacity. Then there is also conditions, where they say the conditions cover the terms and covenants included in the loan or credit facility agreement. So the lender must ensure that the loan agreement clauses are legally enforceable. Then the last one is collateral, where they say collateral means that the asset offered by the borrower to secure the credit. While this collateral is a prominent part of the 5 Cs, it is to be noted that most of the high quality credit worthy customers, for instance, AAA rated corporate, need not extend collateral in most cases. Often, AAA companies obtain credit with negligible terms and conditions. And similarly, in non-recourse project credit or factoring, the suppliers of credit cannot insist upon any collateral at all. So it is a rule of thumb in credit that the credit must be able to stand on its own with the support of any collateral. So the collateral is just an additional comfort that is being offered as well. So you should be able to state and discuss the 5 Cs of credit. So to answer that question, it means you should be able to state and discuss the 5 Cs of credit. Are we on the same page? Any questions? Anyone lost? So we are now done with study unit 1. Please take note that the timetable is already on the website, which shows us exactly when are we going to be having the next class. So please take note of the timetable that is on the website. Also, in the next class, we're now going to be looking at study unit 2. Remember, there are 12 study units that you need to cover for the curriculum. So we're now done with study unit 1. So in the next class, we're going to be moving on to study unit 2. Are there any questions? Anyone lost? All right, if there are no questions, enjoy the rest of your weekend.